Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Well, hello and welcome to our first episode of Different Makes a Difference. I'm Stephen Boland. I'm an equity analyst with Odlum Brown, and I'm here today with Murray Leith. He's our Chief Investment Officer. Welcome, Murray.
Good to be here.
So we debated the topic of our first podcast, and in the end, we decided to go with what's probably on a lot of people's minds right now, and that's Donald Trump. So let's see if we can make some sense of the world under President Trump 2.0. So Murray, there is just a lot going on with this Trump administration. I find it exhausting personally trying to follow the news flow. How do you parse out what's important versus what's just noise?
Well, that's a great question. And it is exhausting and it's not easy. And the answer is complicated, unfortunately. There's a lot of layers and things to think about. I might suggest that we structure this conversation in three buckets. The first one is sort of the what and the why of Trump's key policies and what impact they'll have on the economy. Secondly, we can go through the impact that his policies will have on the stock market. Thirdly, let's talk about how do investors deal with all this uncertainty. And perhaps the fourth bucket would be silver linings, which maybe we can wrap up with at the end.
Well, I like that framework. So let's start with the first point, Trump's key policy pillars. What are they?
Sure. There's six, really. The first one is lower taxes. Second, less regulation. Third, smaller, more efficient government, and also smaller budget deficit. That wasn't on the campaign trail, but it's certainly clearly in the agenda, which is good. The fourth bucket is immigration and securing the border. Frankly, it's a scapegoat policy that sells well with voters, in my opinion, but it's questionable whether or not it helps the economy. Longer term, not having immigration or as much immigration really undermines population growth, which really is needed to help pay for all the entitlements for an aging population. The fifth bucket is trade and industrial policy, primarily with Trump through the use of tariffs to generate revenue to pay for tax cuts and also to create more and better American jobs. And the last bucket is foreign policy, aimed at improving military and economic security. While what Trump is doing on the geopolitical front is beyond, I think, what we want to get into today, it is worth noting that Trump's radical and controversial approach has caused NATO countries to dramatically up their commitment to defense spending. Now, investors were initially really excited about Trump's second term because they believed that the first three pillars, lower taxes, less regulation, and smaller government, would be positive for productivity, economic growth, and ultimately corporate profits. While everyone acknowledged that deportations, reduced immigration, and tariffs could be inflationary and negative for growth, most believed that Trump's bark would be worse than his bite. But of course, everybody now is sort of second-guessing or questioning those assumptions. Moreover, I'd add that investors are starting to realize that the sequencing of the policies is potentially going to weigh on the economy in the near term and potentially cause inflation to be stickier than formerly believed.
Can you explain what you mean by that?
Sure. Deporting illegal immigrants and letting fewer people into the country will limit the size of the labor force and potentially put upward pressure on wages. That's great for the average American, but potentially not great for corporate profit margins. Firing federal employees may contribute to a more efficient economy and help balance the budget in the long term, but it will drive up unemployment and hurt the economy in the near term. And tariffs, of course, are potentially inflationary and negative for growth in the near term. So those three negative influences on growth come before the things that will help growth, namely lower taxes, less regulation, and more efficient government. In Trump's first term, the opposite was true, with big tax cuts coming first. Recent economic reports have pointed to economic weakness, including a very weak jobs report from ADP today. And in Trump's address to Congress last night, he acknowledged that his policies might cause some short-term pain. He said that's okay, but really it's unclear how much pain America is willing to endure. The U.S. stock market has now given back all of its post-election gains, and many, if not most, of the so-called Trump trades have completely reversed.
Yeah, that's really interesting. I'd like to bring it to a March Odlum Brown report that you wrote, and that's our monthly newsletter. And you titled the lead article, Warren Buffett Cries Wolf on Trade. And we'll include a link to that in our show notes. But in that newsletter, you explain the cause of America's persistent trade deficit and why trying to lower it is understandable and desirable for Americans. Can you explain that to our listeners?
Sure. One of the burdens that comes with the privilege and benefits of being the world's reserve currency is that the US dollar is persistently overvalued. And that overvaluation renders foreign goods cheaper and domestically produced goods uncompetitive. And that's caused America to run large trade deficits. And over time, those deficits have caused a hollowing out of America's industrial base. And that in turn has destroyed communities and really gutted the country's middle class. And it's what has fueled social unrest in America and Trump's power. The trade deficit is something Warren Buffett has worried about for decades. And he wrote about it, or the need to fix the problem, in an essay that he published in Fortune magazine 22 years ago in 2003. Now, Buffett and Trump agree that the trade deficit is a problem. What they don't agree about is if whether or not tariffs are the answer. And Buffett clearly doesn't believe that's so. In business school, they preach the benefits of trade. If countries specialize in producing whatever they're comparatively better at and trade with each other, every country can have a bigger economic pie. And nobody really disputes that. What wasn't taught or widely understood is the impact that trade has on the distribution of wealth. And in America, big companies and those who own them have gotten a much bigger slice of the pie, while the average American has gotten a smaller piece. Big companies have increased their profits by outsourcing and offshoring production to countries where labor is cheaper. American workers have lost out to cheap foreign labor, and big business is really the consequence of that. And Trump believes that tariffs can reverse that.
So do you think the Trump administration will achieve this goal of bringing manufacturing back to America and creating more and better jobs for Americans?
Well, I think the answer is complicated and unclear. For that to happen, I think you need to have both foreign and domestic businesses move production to the United States. Because labor is more expensive in America, that means higher costs, which I think translates into higher prices for both consumers and businesses. It means better wages for American workers, and that in turn probably means lower profit margins for American businesses. And that's where it gets complicated. It's kind of like saying we will change how the economic pie is divided. Big companies and the rich are going to get a smaller slice, and the average American's going to get a bigger piece of pie. In other words, less inequality. And I think that's what Americans voted for, but it's unclear if that's what Trump is going to deliver. You got to remember that big business has a lot of influence in America.
So less inequality, is that not a good thing?
Oh, absolutely. It's a good thing. And frankly, it's something that we've worried about for a long time. I think, having less inequality in the world is a must for a brighter future. But the question comes back to is, I'm not sure if that's what Trump is going to deliver.
So we're recording this episode on March the 5th. It's quite possible that the tariff situation will have changed, at least to some degree, by the time we release this episode. Trump is not particularly known for his consistency or predictability, but I'm going to ask the question anyway. How will tariffs impact Canada economically?
Well, I think it's a certainty that the tariff situation will change, perhaps even today. The fact is nobody knows what's going to happen to tariffs over the next week, month, or even year. And even if we get relief on the current ones, there are other tariff initiatives and dates that are still on the horizon. So the bottom line is we could be living with, or we probably will be living with tariff uncertainty for some time. The tariff war is going to be tough on Canada and whether or not we get relief or not, because our country is vulnerable. Our economy was already weak and facing a number of headwinds. Our productivity is poor because we haven't invested in businesses, research and development, and innovation like we should have. We're a country of real estate speculators. Consequently, housing is expensive and unaffordable, and our consumers are over-leveraged with a lot of mortgage debt. The real estate market right now is weak and likely to get weaker because there's a ton of rental and condo supply coming on the market at a time when consumers are feeling the squeeze from higher mortgage expenses and higher inflation. And those mortgages are rolling over and being renewed at higher rates. In fact, 60% of Canadian mortgages will renew in the next 2 years. Canada had a great immigration policy, but we overdid it. We let too many people in too quickly, and that put pressure on housing, pushed up rents, and made already long healthcare lines longer. And we're unwinding those excesses now and reducing immigration, and that's going to put a damper on growth in the near term. Tariffs simply add insult to injury. But there's a ton of unknowns. How long will the tariffs last and at what level? How serious are we about retaliation? Because those retaliatory tariffs are going to hurt us too. What will the Bank of Canada and the government do? Will we print money and lower interest rates to support real estate in particular and the economy in general? How will the government support businesses and individuals hurt from the trade war? Will we hand out money again? Those policies could weaken our dollar and aggravate both inflation and Trump. And then there's the question of who will lead the country, and will they deliver pro-growth policies that will help Canada improve its future? We desperately need to stimulate investment in Canadian businesses, but all the uncertainty is probably going to cause investment to drop in the near term.
So you're saying that slower economic growth should be expected and a recession is possible in Canada. What does that mean for the stock market?
Yeah, slower growth and risk of recession, particularly in Canada, is a possibility. And economists are even, saying the risk of recession is rising in the US. But that's where it gets interesting because the economy and stock market are not always well correlated. What really matters is what's discounted already in stock prices. Listeners might be surprised to know that with the exception of India, the US is the worst performing stock market this year. And there are a number of reasons for that. Number one, and probably the main one, is that the US market was the most expensive market at the start of the year. Secondly, the S&P 500 companies, the big American companies, generate more than 40% of their sales overseas. For the Magnificent Seven, it's 55%. And those sales will come under pressure, or they come under pressure when you beat up on the rest of the world. And thirdly, many of the big companies increased their profit margins in recent years by moving manufacturing overseas. Margins are at record levels, and tariffs could put margins at risk. The big American companies, particularly those Magnificent Seven, have delivered absolutely fantastic returns for investors over the last 10 to 15 years. But as I said before, they're not cheap. The priciest of the bunch are probably most at risk, and I think you want to make sure that you don't have too much exposure to them. I'm not saying have none, but we think you should be limited in it. We think high quality but less popular stocks with better valuations will fare just fine over time, although you have to always expect volatility. The big unknown is whether Trump and the American people are prepared to endure short-term pain, higher prices, and economic weakness to bring manufacturing jobs back to America. And perhaps the bigger question is how corporate America and their powerful lobby groups will react. Money is power in America, and it's hard to believe that corporate America will accept a smaller slice of pie sitting down. Who is Trump going to cater to in the end is the big question. Wall Street believes he will ultimately bend to corporate interests, and that's probably a reasonable expectation. Longer-term interest rates are coming down in both Canada and the US as investors are starting to expect more rate relief from central banks, and that will certainly help mute the economic impact and also support the stock market.
So there is a lot of uncertainty around tariffs. How will governments and central banks react? What will happen to inflation? And all the other unknowns. How should investors deal with this uncertainty? And how should they position their portfolios?
Well, I think number one, make sure you're diversified. across diverse geographies and sectors within the equity markets, and also with fixed income. Don't have too much exposure to the popular and pricey stocks. We always say that if you don't have some stocks that are in your portfolio that are causing you some grief, you're probably not diversified. Often the out of favor securities are the ones that provide some of the best long-term returns. Generally, own good companies, focus on the long term, and know why you own each of the businesses. We always want to be more excited about a stock when it gets cheaper. And if that's not the case, it's probably time to move on. We don't believe in market timing because it doesn't work. Stocks do 10% over the very long term, and the vast majority of those who try to do better than that 10% by jumping in and out of the market end up doing worse. Just think about the last 5 years. We had a pandemic, and most thought that it would result in a long and grueling recession. It ended up being only 2 months, the shortest on record, because governments and central banks added a ton of stimulus. And then when central banks reacted to inflation and jacked up interest rates, everybody thought that we'd have a recession. Of course, we haven't yet. So since the end of 2019, a portfolio of American Canadian stocks has roughly doubled in value. That's about 14% compounded annually. If you were on the sidelines for any amount of time anticipating recession, you didn't get that return. Beyond stocks, you have to make sure that you have the right asset mix that's right for your circumstances, your time horizon, and your risk tolerance. Money needed in the next 5 years should not be in the stock market. Stocks did a lot better than bonds last year, so people should be rebalancing back to their target asset mix by selling stocks and adding to fixed income. And even holding a little extra cash for opportunities is not a bad idea at this juncture. In our model portfolio, or our all-stock model portfolio, we have about 6% cash right now.
I think there's a lot of really good points there. Let's just zone in on the stock market for a moment. Are there any specific areas of the market that you favor? And are there areas you're worried about?
Frankly, the importance of diversification is the main theme that we keep emphasizing. But having said that, I think dividend-paying stocks should perform better in a slow-growth world. Things like utilities, pipelines, telcos, and even banks have good dividends that are secure and should grow over time. Banks could face some downside with economic weakness, but because valuations are relatively low, we think the downside risks are manageable. Some of the stocks that have fallen in the face of the tariff war look attractive to us. Railroads like CP, which I know you cover, Steve, I think is pretty attractively priced here. And it's still going to grow irrespective of tariffs. And General Motors is also extremely beaten up. And it's been pricing probably a couple of recessions for a long time, trading, I think, less than 5 times earnings. So those are a couple of examples. I also think Canadian energy stocks are attractively priced with excellent free cash flow yields. And contrary to what Trump says, America does need our oil.
One thing I always like, Murray, is how you look for silver linings during chaos. And I know you believe there are some right now as well. Why don't we wrap up this discussion by having you share some of what these potential silver linings are?
Sure. I think it was Winston Churchill who said, never waste a good crisis. And I don't think we will in Canada. Canadians are upset and scared, and we're also very united. Even Quebecers are waving the Canadian flag with interest in separation the lowest that has been in a long time, perhaps ever. I believe politicians of all stripes, at all levels of government, are going to focus on doing the things that we need to do. I believe we'll do it because we have to. We trade more north-south than we do east-west, and it's about time that we have free trade in Canada. And I think we will make good progress on that front. We need less red tape, more efficient government, and we need to support business creation and investment, have more research and development and innovation, and we need to diversify our trade. I think we have a tremendous opportunity to do better, and I think we will. The Canadian dollar is very undervalued, and while I think it could get a bit weaker in the near term, I believe there's a lot of scope for it to appreciate over the next decade. So the silver lining is this crisis has given Canada the kick in the pants that it needs to do the things that it needs to do to brighten its future.
Well, I find that really encouraging. This was a great discussion. Thank you so much, Murray, for sharing your thoughts here today. there is a lot of uncertainty out there, and it's really helpful to get your perspective. Trump is doing some of the things he said he would do, and some of that is unnerving. His actions bring risk to both the Canadian and U.S. economies, but it's tough to say how much short-term pain he is willing to bear. And there are, as Murray pointed out, potential silver linings. From an investment perspective, we're staying the course, recommending good businesses that are reasonably priced. We're advocating diversification and proper asset mix, and that varies by individual. And we're largely resisting the temptation to try and time the market, knowing that tends not to be a successful long-term strategy. We are now 2 months into Trump 2.0. There's a lot more to go, so this is a topic we could certainly revisit down the road. In the meantime, thank you all for listening. Have a great day, and we look forward to talking again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.